The second thing we want to look at is mergers and acquisitions. And this is an important and really sometimes really difficult thing to analyze because of the rules about reporting acquisitions. So unless an acquisition is deemed material by the company's accountants, and material here can be a very loose term, right? Material means, do they think this company will actually materially change the firm? And there are some sort of soft guidelines on what material should be. For instance, you often won't even hear any mention of a company that's smaller than 5% of the purchasing firm's value. So a really small compared to the firm that acquired it. But there is no hard and fast rule that says if it's bigger than 5%, it has to be material. I've seen some acquisitions that are 10 or 15% of value that aren't considered material, which I think is kind of bogus. So you got to be careful here. For these small companies, they may not report it at all. For larger companies that are deemed material, the company will they'll provide some pro forma statements so that they can recast financials, historical financials, so that it looks like the company was bought at the beginning of the year. They then provide all the relevant information about the purchased company's revenue, etc., like things like that. They basically like a shrunk down income statement and balance sheet for the company that they bought and how that combines into the company that they are now. Also, if the target company, the purchased company, is really big, if they were already a public company, they provided their own financial data previously, so we're going to have to go look at their financial data and then look at the new company's, combined company's financial data, and we can manually disentangle how the revenue changes, right? Because all that happens here is the company is going to, the purchaser, the acquiring company, is going to add the revenue and the cost and the taxes and all the other stuff. They're going to add the income statements together. And so that means revenue from one year might go from $1 million to $10 million and just jumps, right, from one year to the next. And that jump is entirely composed of not organic revenue growth, not more people buying your product or you releasing a new product that got really popular. Simply just the revenue of this other company that you bought. Now, if it's a big company, this is going to be obvious because it's material, it'll be reported. Like I said, Apple has a history of buying like a small company, make an acquisition every 3 days. And these are tiny companies. Apple might spend, a couple $100,000 or a couple million, which for a company of Apple's size is trivial, and they just don't even report it. And of course, the revenue of these companies might also be trivial, but that's every 3 days means they're making 50 acquisitions a year. And 50 acquisitions, the revenue coming from 50 acquisitions that are unreported is going to juice revenue year over year. And unless we can figure out a way to remove the acquired revenue, it's going to make Apple look like they have revenue growth rate that is not what their actual revenue growth rate is. And here's how it can happen. Right. So let's consider a hypothetical example here. We got two companies. So you can see in the table parent company and target. So the parent is the acquiring company and the target is who's getting purchased. And the target is small, but 20%, they have about 20% of the revenue of the parent. So I think under any circumstances this would be considered a material purchase. We don't have value information, but 20% of revenue means they're probably similar in percentage of value. So the parent company and the target company are both growing revenue at 10% a year for the next 5 years. So from 100 to 110 to 121, etc., 20 to 22 to 24, that's a 10% year-over-year growth rate every year for 5 years. Now the acquisition happens in the middle of year 3. And so what that means is that the parent company is only going to add the revenue of the target that actually occurs after the acquisition was made. So here, the acquisition was made, we're like 7 months in. So the acquisition occurs and only 14 million of the total year's revenue, and the total year's revenue for the target was 24 million. So only 14 million of the total year's revenue is going to get added into what we call consolidated revenue. And consolidated revenue is here, that third line. So you see the revenue from the parent, that's the same because the parent revenue doesn't change. The revenue from the target, only a part of the third year's revenue gets added, 14 million of 24. But look at the bottom line, from year 2 to year 3, all of a sudden my consolidated revenue, what the parent is reporting, went from 110 to 135. Now I know that the parent only had 10% revenue growth organically. But if I just take the growth rate of 110 to 135, I have a 22% growth rate. This just makes it, all of a sudden it looks like the parent is performing like insane. And that's not true. All they did was add another company's revenue to theirs. And we can see that that effect persists into year 2, because now I'm adding the complete full year's worth of revenue for the second year into my consolidated revenue. And because I'm adding a full year and the first time in year 3 was only a partial year, I have another big jump, a manufactured increase in revenue growth of 18%. But then from year 4 to year 5, because both of these companies organically are only growing at 10%, I'm back to a 10-year growth rate. Right? And it's these 2 years here that are distorting the picture and making it look a lot different. And if I was continually making acquisitions, I could continually distort this revenue growth rate and make the firm look outstanding when really it isn't that good. It's just making lots of acquisitions. And as we know from the chapter on growth rate, mergers and acquisitions are historically one of the poorer performers in sustaining revenue growth because of difficulty integrating the purchase company and other things like that. So we have to be really careful here. Now, the last thing that can affect, or the last of the sort of major things that can affect revenue in a mechanical way, not an organic way, is an accounting change that causes us to report revenue in a different way. And one of the more important things that we have to worry about is, for instance, some recent accounting rules changes by the Financial Accounting Standard Board or the International Accounting Standard Board that cause a company to change when and how they recognize revenue. So, for instance, we might be able to say delay revenue, and this often happens when, for companies that offer things like warranties, they're allowed to delay the revenue until it's established whether they have to pay a warranty. And so that means they don't book this revenue, but there might be a standard change that says something like you now have to book this revenue concurrently and then book it as a cost if you have to pay out on a warranty. And so where they were previously delaying it, they now have to shift all of that delayed revenue to the current year. And so then you see a big spike in revenue in the current year, kind of like with an acquisition. And that is not organic revenue growth. Again, that's just a change in the way that the revenue had to be reported. And it didn't have any effect on the material of the business. And so this thing is not, if it really had a big impact on the firm's accounting, they would report it in the financial statements. If it didn't, it would just be something that we had to be aware of, like, 2017, big revenue recognition change. We got to make sure that we've corrected in our analysis for this revenue recognition change. And once we have corrected all of our revenues, then we can analyze revenue in the same way we did ROIC. We can make a decomposition of growth, and our decomposition of growth is going to be way more simple than for return, because there's only one item here that we're looking at. How did revenue change? And the only thing that we're really going to decompose revenue here is in terms of units. So we'll look at revenue per unit and the number of units sold. And so we can jump back to an example we've used a few times, which is Home Depot and Lowe's, and we can compare their revenue growth. And if we look at the top line revenue growth, and again, this has been corrected for all of these issues, and you'll notice that there's a footnote down at the bottom excluding Lowe's purchase of Orchard Supply hardware. So we had to correct Lowe's revenue growth for a big purchase. But if we look at just their organic revenue growth, we see that it's about the same. Home Depot's growing revenue at slightly higher percentage than Lowe's, but not enough to be material. And we can break down into a tree. We can look at the units here for a company like Home Depot and Lowe's is not like, say, if you were a bicycle company, the units were discrete and very noticeable, a bike. For a giant retailer like Home Depot and Lowe's, we don't really have units per se, because of course they sell a million different things in their stores, and they're not all the same, so we can't look at revenue per unit. But if we think about a retailer like this, we can sort of broaden our definition of what a unit is, and if we do that, then we can say that the unit of Home Depot is actually the store. And so then if we look at them in terms of their stores, we can get a better understanding of their business. And so we can break down into revenues per store and the number of stores, because we're going to use store as the unit. And so Home Depot and Lowe's, if we look at their revenue per store, again, about the same. Home Depot's making a little bit more revenue per store, but not materially more. And the number of stores they have is about the same. So Home Depot and Lowe's tend to open up in the same town. They tend to open up pretty close to each other, and there isn't that big of a difference in terms of the total number of stores that they have. So we want to break it down a little bit further. We'll break apart revenues per store. So we'll look at the things that make up revenue for Home Depot and Lowe's, and we can look at something called transactions per store. So how many transactions go on, and dollars per transaction. How valuable is each sale? And so we'll look at that difference, and we see that there is a big difference here. And this difference is going to speak to differences in the companies themselves, kind of like differences in FedEx and Home Depot. We originally thought they were pretty close competitors, and then it turns out that their businesses are actually pretty divergent within the same space. Home Depot and Lowe's turns out to be a similar story. So Lowe's has more transactions per store, but Home Depot gets more dollars per transaction. So they sell even though Home Depot has less number of sales, each sale at Home Depot is more valuable. So we want to understand a little bit more about what that drives that story. We can look more at the store itself, and we can see that we can go down into a non-financial metric like square feet per store, size of the total store, and we see that the difference is minimal. There isn't much difference. They're about the same size, the average store. But if we look at transactions per square foot, we again see that Lowe's has significantly more transactions regardless of the size of the store, right? So that first measure could have been Lowe's had more transactions per store because Lowe's had bigger stores, so they just had more transactions. But store size isn't different. And if we look at just by square footage of the store, Lowe's has more transactions, even though they're lower dollar. So what is the difference here between these two firms, and how are they driving revenue growth? Well, it turns out that the difference is that Home Depot focuses more on professional sales. They focus more on contractor sales, so they're trying to sell more to professional builders and contractors, remodelers, things like that. So their dollars per transaction are higher, even if they're making less of them. Whereas Lowe's is focused more on personal, and so they're bringing in more people to buy lots of smaller items, people doing their own personal renovations.